Hello everyone and welcome to your Glassnode video report for week 23, 2023. So as of this morning, and remember I am in Australia, so I kind of wake up when the rest of the world has already had their day. We've essentially seen the market sell off on news of Binance and various allegations and charges by the SEC. Now, what is quite interesting is that we could actually see this in the report that we released yesterday was actually prior to the sell-off, which really showed that there was a structural change going on under the surface that suggested there had been a risk of capital rotation. So on-chain data is really powerful at this because we can see how asset preferences move. We can see changes in trade volumes, for example. We can see changes in the amount of coins flowing in and out of exchanges, the balance between stable coins versus the majors. And what we'll look at is some regional divergences as well, which is really showing that kind of regulatory hotspot that's going on in the US. So we are going to be focused on this concept of capital rotation, how we can use on-chain data to really track these asset preferences and try to spot these moments of risk-off sentiment kind of before they kick in. So over recent weeks, we've talked about how the market went pretty quiet. There has not been much activity, volatility crept out of the market, and usually this precedes a fairly significant move. And here we are, whether this is the start of the move, whether we still have up, down, left, or right to go, what we are seeing is these underlying currents. And these are kind of bigger picture views that we can see within the on-chain data. So in many ways, we can use this as a bit of a backdrop. And certainly we're looking for changes, right? There's been a very distinct shift, and we'll look at some charts that cover this. There's been a very distinct shift in the market's preference, particularly relative to Q1, and certainly Q1 was relatively different to 2022. So there's kind of three phases of this market, and we'll touch on how that's evolved through several different charts. So we're going to be focusing on primarily stablecoins, Bitcoin, and Ethereum. And really, the reason why we're going to do that is essentially where the vast majority of capital comes in or out to this industry. Generally speaking, it comes in through the two majors or through stablecoins. So we are going to use those as our focus point because essentially we're already going to be capturing some 95% of the true value that's in this market. So as always, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. Let me know in the comments what you think of this particular session, because it is going to be focusing on a more structural, big picture view, which helps us inform what is going on under the surface. Let's get started. Okay, so as always, we're going to start with our price analysis. Now, what we've got here, and again, what I like to do with these prices, because I mean, we can just show price, but that can get a bit boring at times, is really show you some of the tools that we can use in Workbench and just some different ways that we certainly visualize things on our end in the analysis team. So what we've got here is the Bitcoin price year to date, and I've essentially set up two different price charts. So here in the red, I'm using the cumulative max function as well as the subset function. So what the subset function is going to do is limit it only to data beyond, so basically from year to date, from 2023, 1st of January. And then what we're doing is we're taking the cumulative max, which is essentially the all-time high. You can see that we're tracking the all-time high of the 2023 market, right? Which is currently sitting up here at 30,900. Now, what I've also used is an interesting little formula where we essentially take the inverse of that. So what we're doing is we're inverting the price chart and we're trying to find the 30-day minimum, which if you invert the price chart, it's going to be the 30-day maximum. So what we're doing here is trying to capture what is the 30-day low. And what you can see is that literally as of the candle this morning, we have broken down below that level. And you can generally see that we have been in a period of ascending 30-day lows. We are now in a period of descending 30-day lows. So again, there's lots of ways we can look at this, technical analysis, on-chain, but just another way to kind of visualize things to say that in particular, this candle has perhaps started somewhat of a bit of a momentum to the downside, but more so just an interesting way to visualize and use Workbench tools to try and capture all sorts of different dynamics. Okay, so we're going to start our on-chain journey looking at the stablecoin market. And I mentioned at the start that we've kind of got these different phases of the market. So on the left-hand side, basically the left half, this is looking at all stablecoins, Tether in green, USDC in blue, and then we've got DAI, BUSD. BUSD is probably the only other one that kind of reached any sense of scale. We do have DAI and TUSD, but we're kind of going to ignore them because they're a bit small at this point in time. That may not stay the case, but that's where it stands at the moment. So on the left-hand side, we've had the stablecoin expansion through the bull market. You can see there was kind of two growth phases. May 2021 was kind of the end of this parabolic phase, and the gradient really slowed down. But it was the collapse of Luna, which, as we now know, was a significant start to a deleveraging event. So in the second half of 2022, we can see that stablecoins actually started to decline in overall supply. Now, in terms of general structure here, it initially was Tether seeing massive redemptions, and USDC took some chunk of that. Well, over the course of 2022 and into 2023, USDC is now the one that's actually falling off, and we're seeing that USDT is now at an all-time high of supply. Now, there's a lot of factors at play here. It's never going to be a simple answer. However, one observation is that generally speaking, USDC has been the preferred stablecoin instrument for US regulated entities. Tether, on the other hand, has seen far wider adoption outside the US. So what has really changed over the course of 2023? Well, interest rates have seen their largest hiking cycle ever. And if you're a US regulated entity, these stablecoins pay you no interest. If you are outside the US, in many instances, you happen to have a slightly weaker currency than the United States dollar. So therefore it is, and also you don't have access to those same capital markets. So there is a transfer of essentially a capital rotation here towards Tether, because entities who prefer USDC historically now have access to 5% interest rates in domestic markets, whereas offshore, access to dollar liquidity is far, far harder, and many of those currencies are struggling. Me as an Australian, I mean, the Australian dollar chart hurts to look at most of the time. So, you know, as you get further outside the US, right, further away from that US dollar-centric environment, the preference towards Tether relative to local currencies actually grows. So there's a bit of a national or a regional divergence happening, which we'll explore in a bit more detail. The only other thing I want to flag is BUSD. Essentially, the SEC has alleged that it's a security and Paxos can no longer issue it. So it's essentially in redeem-only mode. And given the news today about Binance, likely that is going to continue to progress. Now, another way to visualize that is by looking at the 30-day change. So just to quickly take a snapshot, this is our aggregate stablecoin supply chart. We have growth on the left-hand side and we have a decline on the right-hand side. This here is essentially visualizing that 30-day rate of change. So you can see the explosive growth all the way through to May, where we're seeing $24 billion a month. I mean, incredible sums flowing into the stablecoin market. So this is supply growth, a much lower growth up until the lunar event, and then we moved into a net outflow regime. Now remember, some of this is going to be driven by BUSD that's redeem only. Some of this is USDC seeking better interest rates elsewhere. It's being offset partially by Tether demand, but net overall, all things considered, stablecoins are seeing their supplies diminish at about $1 billion or $1.3 billion a month at current rates. So overall, this is a net capital outflow from the industry. And you can see here, this is just for a bit of a sense of scale. This is Tether dominance. It got down to 44% following Luna, and it has now risen all the way back up to 67%. So Tether dominance continues to grow. USDC is declining. And as I mentioned before, there's a bit of a regional sense to all of this. And we're going to actually show this in another chart, this one in particular. So this chart is a really interesting dynamic. This is available for our professional members. And we actually just released, you'll find a link in the description below to this chart's in a dashboard called Regional Supply Change. And what we're basically looking at is we've taken all of the trading activity, right? Whether it be price charts, we have some on price. This one here is specifically looking at balance change. And what we're looking at is all the Bitcoin wallets that are out there. Which ones are active during US trading hours, which ones are active during Asian trading hours, and which ones during European trading hours. And we use entity adjustment to, try and cluster and work out, okay, these are most likely US related entities. These are most likely in the Asia and Pacific region, and these ones here are most likely in Europe. So from that, we can basically look at not necessarily how much their supply has gone up or down, how much their relative share of the overall supply. So there's a fixed pie of Bitcoin out there, the circulating supply, how much of that is held in each of these different jurisdictions. So the real takeaway here, the US is in blue, we can see that Asia is here in red and Europe is in orange. So the big takeaway here, let's really look at the right-hand side of this chart. You can see that the US was a primary buyer, or they were building their market share of Bitcoin quite significantly through 2020 and into 2021. Now remember, back here is when Michael Saylor and MicroStrategy first announced their purchases. We've had the COVID collapse. Monetary policy is, everybody's kind of coming to terms with this new world that we live in. And that really petered off and started to decline. Their overall dominance growth really started to decline again through to the Luna and 3 Arrows Capital event. Now, especially following FTX, note that the US dominance here is actually collapsing and accelerating to the downside. This is being picked up mostly by traders within the Asia and Pacific region. So what we're seeing is that the US dominance of Bitcoin supply is actually declining to a similar extent, down 11% in overall share relative to where they were just 1 year ago. Now, Europe is 9.9% of that 11% is going towards Asia and the Pacific, and we're seeing that Europe is catching up basically the other 1%. So really, it's kind of a west to east type transition of overall dominance. And again, this kind of speaks to that. Well, you can get 5% interest rates in the United States on the risk-free treasury asset, so to speak. Whereas elsewhere in the world, many parts of the world just simply aren't that lucky to have stable currencies, to have interest rate markets and capital markets and access to them. So there is a regional divergence. We also have all of the regulatory pressures. It's an increasingly hostile environment in the US, and this is likely being reflected in this chart as well. So many factors, but all in all, kind of telling this this overall flow of funds and really who is growing their share and who is not. Okay, so bringing it back to that original concept, that's kind of the whole regional concept, one packet of information. The second thing I want to look at, this may look similar to the stablecoin supply chart, and it is very similar. I mentioned at the start that we have Bitcoin, we have Ethereum, and we have stablecoins. And they are the primary entry and exit points for the digital asset space. That is where most of the capital comes in and out of. Now, when we look at market cap, is it really fair to value Satoshi's coins at the spot market? Not really. Is it really fair to value, ETH ICO tokens that that have never moved since that point in time? Probably not. If they move, when a coin transacts on chain, we have a realized value. So the realized cap is kind of a liquidity adjusted approach to this thing. So what this chart is capturing in red is the total between Bitcoin, Ethereum, and stablecoin. So Stablecoin Supplies, Bitcoin and Ethereum realized caps. So trying to capture the true market liquidity within these top assets. And the high level view is you can see a very, very similar pattern to our stablecoin chart. And you can see we're kind of just plodding along sideways. Now, the big takeaway there is we don't exactly have a great deal of capital flowing in 2023, despite the fact that prices are up. So overall, it's not negative, right? This was clearly negative in the second half of 2022, but we are just kind of slowly grinding higher. So it kind of really does speak to that. We're up in terms of price, but it's not exactly raging bull market like we've seen before. So it gives you a bit of a gauge. Capital's flowing in, but with a bit of an asterisk next to it. Let's dive into that a little bit more. So then the question is, how much of that is being led by Bitcoin, Ethereum, or stablecoins? So what this chart is doing is, again, taking that 30-day change of those curves we were just looking at, so 30-day change of the realized cap. This is really showing us where the capital is flowing in. Now, really interesting, back here in the bull market, note that Bitcoin leads. Capital flows into Bitcoin first, and then we see the Ethereum wave follow in blue. Same here on this second rally, right? Now remember, we're kind of in full bull market mode back here. Bitcoin leads, Ethereum follows. So we see this capital rotation. You can actually see the periods in time when Bitcoin capital flows downwards, and we actually see that rotation into Ethereum. Now, what we can also see in the background here is the stablecoins, and you can see that stablecoins are obviously much smaller than these assets. But what you can see is down here, stablecoins are seeing net outflows. Let's actually just zoom in on a 1-year basis, just to get a bit of a snapshot. Stablecoins are seeing that continuous $1 billion outflow, 1.1 to 1.5. Bitcoin, again, has led the capital inflow. Ethereum followed, but note that both of these are actually currently in a net. They're still positive, but they're not screaming higher. We are seeing a little bit of a slowdown. There isn't the same kind of impulse and momentum. So just something to bear in mind. It's clearly, this is net outflows in the second half of 2022. We've moved to a regime of net inflows, but it's still quite soft. So it's just something to take away. Let's dive in and keep exploring this concept. Now, this chart is a really interesting one. Now that we've got a bit of a gauge on where capital is flowing to and from, generally speaking, exchanges are and remain a centerpiece of the market. They are where a huge proportion of the trade goes on. Whilst DeFi and all these things are evolving, centralized exchanges still dominate in terms of the overall flow of funds. Now, what this chart is looking at is a very, very simple model. It's not perfect, but it's giving us a reasonable idea. Generally speaking, when people send their Bitcoin or Ethereum to an exchange, it's unlikely. Some people send it in for collateral, and some people don't necessarily sell it then and there. But generally speaking, when coins flow in as BTC and ETH, it's likely to be. We're just going to assume that that's sell side pressure. Likewise, when somebody decides to send stable coins from their wallet into an exchange, we're just going to make a really general assumption and say that's buy side pressure, right? So what we're going to do here is net those off against each other. If $1 billion of Bitcoin and ETH, combine those two together, I don't care about which asset it is, just the majors. If $1 billion of majors flows in and 1.5 billion worth of stable coins go in, this chart will go green by $500 million because that's excess buy side pressure. Likewise, if there's 1.5 billion of BTC and ETH sell side and only 1 billion of stablecoins flowing in, we have $500 million of sell side. So what you can see here, kind of interestingly and counterintuitively to what people would think, massive sell side pressure during the bull market. Of course, this is when people are literally taking profits. That's why market tops get established. There's not enough buy side pressure to actually keep the thing going, right? So you can see a net regime of sell side pressure in the bull. Now we had a transitional period into Luna, and then note that following Luna, a burst of buy side. People saw this dip and they said, oh, that's the dip. Turns out it wasn't the dip. There was another dip to come, which people followed, but not quite with as much gusto. So you can kind of say that the second half of 2022 was a bit, it was kind of chopping around. The market didn't really know what was going on. Deleveragings were happening. And then FTX happened. And before that, there was a bit of buy side, but that's when the buy side really exploded. Stablecoins flowing into exchanges, BTC and ETH flowing out. And we did discuss this back then when it happened. And you can see this was the theme all the way through Q1 2023. Well, now let's zoom in on a 1-year basis. Something has changed. Now, we aren't in major sell side territory, but we are certainly not in major buy side territory. And note that when this particular chart reversed, it just happened to be the local high at 30,000. So there has been a regime shift. So this is actually, this will be chart of the week. Something to pay attention to is whether we get this thing start to accelerate in one direction or another. Remember, it's a simplified model. It makes assumptions. But again, we're looking at capital rotation. And generally, what we're looking for is changes in structure. The absolute value of these things tends to not be as important as quite clearly this is different to this. We have seen a shift, and that is something to pay attention to. Now, last couple of charts, with all that as context, it kind of speaks to a bit of a uncertainty, risk off. Capital is kind of a bit nervous, liquidity is down, trading volumes are down. It's a bit risk off when we kind of look at that overall spread of things. Now, what generally happens during risk off events, you see capital flow to lower risk. You don't see long tail assets and highly speculative pink sheet stocks and, tokens that are well out in the risk curve. You don't see those generally perform. You see capital move up to mega caps and larger caps. That's generally how markets operate. So what this chart is looking at, let's take all the inflows and outflows and compare how much of it is Bitcoin versus Ethereum. It's basically a dominance between those two, trying to get a bit of a sense of scale of what the risk appetite is. Now, downtrends and low values mean that there is a risk appetite for Ethereum, and generally speaking, when there's a risk appetite for Ethereum, that flows out on the risk curve. Uptrends, on the other hand, and high values indicate that Bitcoin dominance is extremely high. Now, we have essentially seen since the all-time high here in October 2021, we have seen a net grinding uptrend in Bitcoin dominance. And you can see that we've actually seen a notable uptick to 73% this week. So we are seeing that the majority of capital flows between Bitcoin and Ethereum happens to be moving towards Bitcoin at this point in time. And that, by and large, represents a bit more of a risk-off sentiment. Now, remember, from the charts we saw before, there is actually capital flowing towards stablecoins as well. So, you know, there's kind of three big assets in the mix, but we are seeing that general shift higher up the risk curve. And the last chart we're going to touch on, just to really put a bow on all of that, and really to show that between on-chain data and here we are looking at futures markets, we tend to see a very consistent picture. Certainly in my experience, we see very consistent stories between all these assets because it's just traders expressing their view, whether in futures markets, in options markets, on-chain, indexes. Generally speaking, the aggregate story is actually quite consistent. Now, what we're looking at here is, again, between Bitcoin and Ethereum, we've got all the trade volume in futures. How much of it is Bitcoin dominated? How much of it is Ethereum dominated? Now, what is interesting is that through the course of 2021 and 2022, we actually reached parity, meaning that traders had enough depth and liquidity to trade BTC and ETH for whatever their strategies are. You know, they're able to put a short position on Bitcoin, a long position on Ethereum, or short on Ethereum, long on Bitcoin, trying to hedge different risks, whatever their positions were. They found sufficient liquidity to actually be trading both of them. Now, as 2023 rolled around, and as we mentioned, there's been these kind of increasingly hostile regulations. We're seeing market makers pulling back from the space, trading volumes are down, liquidity is down. There's a lot of rumblings out there in the wider economy. We have seen Bitcoin dominance rise from 50% or at parity up to 65%, and Ethereum dominance has naturally declined down to 35%. So we are seeing this overall migration. Remember, this trend is relatively early. It's basically just been Q3, right? You can see that some of these things can go for many years. We are seeing this trend starting to develop across many facets of the market that's just suggesting that bit of risk-off environment. At the very least, there has been a shift to what we saw in Q1. So just something to keep in mind, and you know, kind of putting all these things in context across several market segments. So just before we close out, I do just want to highlight that many of the charts we just looked at, you will find in our capital rotation dashboard. You'll find this under the market section in Studio. We cover many of these tools, looking at the dominance between stable coins, looking at flows in and out of exchanges, really comparing the majors to the stable coins. This is our buy side, sell side that we looked at. So this is a really powerful dashboard that gives us a view of how money is flowing in and around and cycling between Bitcoin, Ethereum, stable coins, what it means for risk. This is a really powerful dashboard. I find myself personally inspecting this on a regular basis. So just really wanted to flag that before we close out. And you will find a link to this in the description below. So thanks as always for tuning in for that, folks. Hopefully you found that useful. Again, taking a bit of a 10,000 foot view. What is the macro landscape looking like? How is that story told through on-chain and off-chain data? How can we stitch all these puzzle pieces together to really give us a quite comprehensive view of what is going on in the space, and certainly help ground ourselves, right? We can see that Q1 was quite a powerful month, or a couple of months. What we're now looking at is a bit of a regime shift, and it just gives us a series of tools to keep an eye on and track how this evolves over coming weeks and months. So anyway, hopefully you found that useful. Let me know if you have any questions in the comments, and I will see you in the next one. Cheers.